indeed, everyone, for joining us today. We've got a fantastic panel to discuss the rise of private credit. It's grown to a $1.5 trillion industry in recent years. It's really the hot topic that we keep hearing about. And before we start discussing why it's rising, we're going to talk about what exactly is private credit, since it does seem to be a bit of a blanket term. So, Volkan, you're very kindly going to tell us a bit more about what exactly do people mean when they discuss about private credit.
Thank you. Traditionally speaking, if a company borrows capital from a non-bank entity or from a small group of non-bank entities, that you would call private credit. However, this definition, I think, just applies historically at this point. The area, as you mentioned, has grown dramatically. And now, from special situation lending to mezzanine junior capital lending, even distress lending is going under the private credit definition. Whenever there's a story these days, there's a need for private credit. I just wanted to read from a news from yesterday. Hong Kong's stressed developers lure private credit as funding gap looms. So usually, historically, this area was just performing mid-market type of companies instead of going to bank route, borrowing from private companies, private funds, but it's broadened a lot. As you mentioned, it grew towards 1.56 trillion. Expected to grow, certain surveys say, to double that, 3 trillion in the next 5 years. I think there are a couple of causes for that growth. One, for the borrowers, it's appealing. Why is it appealing? Multiple reasons. I will leave my colleagues to speak about that. It definitely involves certainty of execution compared to bank lending. That's on the borrower side. On the investor side, I think that these positions are pretty much hold to maturity. They are not mark to market every day, every week, every month. They get valued quarterly. Is attractive for large institutional investors who do not want mark to market volatility. Maybe.
Thank you. So let's move now to Ted. Private credit is very much a US focus. You have a lot of experience in the market. Can you tell us why is it so popular? What are you seeing in the United States?
Yeah, private credit really became an asset class after the financial crisis. During the financial crisis, every asset class was correlated. Cash, bonds, stocks, agriculture, commodities, metals, everything went down. Private credit is the one asset class that performed. So after the financial crisis, insurance companies and pension funds that needed to know that they had consistent returns turned to private credit. Private credit is senior secured, floating rate, so it's a natural hedge against rising interest rates. Loan to values probably 50%. And throughout the last 20 years, it's been a consistent return player. So pension funds that need a 7 or 8% return, insurance companies that need a 4 or 5% return. Over the last 10 years, when interest rates and the treasuries went to zero, tremendous amounts of money came out of treasuries into private credit. And that's really what's driven the growth of it. And it's become, today, the fastest growing alternative asset class among all asset classes.
And let's now turn, so in the US, obviously very successful, but other regions are catching up, and we're lucky to have Michel on the panel today. So he covers Europe, Asia, also the Middle East. What are you seeing in these markets? Are they catching up, or what's the...
Well, Laura, to Ted's point, it's a very fast-growing market in our regions as well, but the basis is much lower. Mm-hmm. We have been investing in private debt mostly in Asia in the last 10, 15 years, but there's only a handful of funds that do it. There are a number of conditions that are required for such a market to develop itself. And what you need is the rule of law. You need bankruptcy processes, you need creditors' right, which is not necessarily available in every country in the region. And as a result, governments have understood that, and as banks are retrenching increasingly from financing mid-cap enterprises, regulators have come in and have improved drastically, at least in some countries, the bankruptcy process, creditors' right, accounting regimes, and that provides a market with a large amount of opportunities for private lenders like us. You've got to be extremely selective in the markets, in the countries where you operate. And I keep hearing about the new regimes that are evolving here as well, which will pave the way for a growing private debt market. But we're just at the beginning. And the demand-supply dynamic means that while for similar investments in the United States, when you have senior secured debt, you are probably aiming for single-digit returns, we can achieve mezzanine-like returns by buying senior secured debt. But that works as long as you're familiar with the market, you have boots on the ground, and you can have relationship with the companies in which you invest.
Sure. Yeah, absolutely. We'll talk a bit more about returns later. But for now, Ron, would you be able to tell us, you come at this with a very interesting angle, with a very tech-focused angle. Tell us a bit more about what you're doing, how you're doing it, what you're seeing.
Sure. So my colleagues here, they said wisely about the reason behind the rise of private credit, but there's also the element of why it happened. Not just because of economical reason, but because how the world is changing. And the world basically is becoming much faster. Businesses need to grow faster. They need the faster service from banks and from on their lending needs. And this is the place where a lot of technology get involved, but the regulation is always much slower than technology and slower than the market. And this growing gap basically turn private credit as a segment to the only answer to many companies in the world. And as a result, we see that the quality of companies that enter this market and lending through these sources is getting better and better. So when people say private credit, they tend to think distress, they tend to think relatively low places on the capital structure. But today, actually, private credit is available at scale across the entire capital structure. And again, that's because the market gap between regulation evolution to technology evolution that enable much faster due diligence, deployment, monitoring. It also changes the boundaries of securities. So securities are no longer solid assets. It can be potential, right? Everything that I can measure can serve as a security as long as I understand what's involved with the value, the future value of the asset. And that's by itself changed the market. As a result, also we see a lot of late-stage technology companies that prefer to take debt than equity, right? And the reason is that traditionally the venture debt business was all about what was your last round valuation, who are the investors, this is probably how I can hedge it, and it was a lost leader for many banks to take the banking activity. But these days, where it's more tangible to understand the potential of the business, we can actually lend those guys not against assets, but against their potential. And this is where it's become scalable. So suddenly, companies that used to be able to take $10 million from a bank can come to us and take $100 million, as long as the potential is there, and we can track it and analyze it. So, yeah.
Maybe I can add a few on Ron. I mean, historically speaking, when you say private credit, people think of mid-sized companies. This has dramatically changed over the last 3-4 years. We are talking about $4 or $5 billion loans, which can be taken by 3, 4, 5 private credit funds. So as private credit is rising, bank loan, syndicated loan business is getting smaller. As private credit is eating into that area. And I do think that trend will continue. A few key things about private credit. If you're a growth company, there are certain, when you want to borrow money, there are certain things that you do not want to deal with. You know, for instance, is the credit going to come? Certainty of execution. Is it uncertain? How about rating? If I borrow from a bank, I need to get a rating. Maybe a private credit fund, I do not need to get that. So a lot of appeal. And you also start thinking, if I have these 2-3 private credit lenders, in 3, 4, 5 years, I become a bigger company, I can borrow money again. So it's very appealing to the borrowers. But of course, you know, this is still a very fast growing market. It will come with its problems in the future.
Absolutely. Sorry, go ahead.
Yeah, the reason why private credit started in the U.S. was buyout lending, leverage buyouts. banks used to do all leverage buyouts. After the financial crisis in 2007, 2008, the regulators came in and required the banks to put very high capital charges against leverage buyout loans. Once the banks had to put high capital charges, they stopped. When I started this business 25 years ago, 90% of the buyout loans were in banks and 10% were outside of banks. Today, 90% of the buyout loans are outside of banks and 10% are in banks. So what's happened is the entire industry, private credit didn't just blossom and grow, it took market share away from the banking system. And then the regulators wanted to push out all of the risk loans out of the banking system and into the institutional market. So since then, what's happened is private credit has developed across all asset classes: real estate, software, technology, healthcare, venture debt. Every asset class now has private credit. And it's because institutional investors are far better at underwriting and selling and closing with certainty these loan assets than regulated financial institutions. It started in the US, it went throughout Europe, it's in the process of becoming mature today in Asia. It has not happened in the Middle East yet, but 5 years from now when we come back, private credit will be the hottest asset class in the Mideast.
Absolutely.
I would like to add to that something. I think that it's also the fact that the banks discover that it's way more efficient for them to focus on wealth management type of activity and push this type of risk away from the balance sheet. So basically they still do it, but they just do it through external financial institution.
Okay. So we've talked about why it's so popular with borrowers, with investors. Can we talk about return expectations within the asset class? Michelle, maybe we can start with you. What are you seeing in that sense?
So for us, in terms of return expectations, because we are at a stage in the development of our markets, as Ted pointed out, which is still very early stage, and at the same time where we have commercial banks that are retrenching heavily because of the regulatory issues that have been pointed out, but also because of the market in which we operate, where banks have moved from being global to becoming regional to becoming national. And that means that they're only catering to their very large clients. It means that we can be extremely selective about the companies that we work with, and we can also dictate our conditions. And as a result, we are not going to do deals unless we can do mid-teens type of return, and again, with senior secured type of structure and in jurisdictions that are very efficient and very creditors friendly. We're not talking about emerging market because the regulators, the banks, everybody's understood that this is a need, and a need that's now slowly coming to this region as well. Absolutely.
And Ted, what would you see in terms of in the US in terms of returns?
So private credit historically has been a LIBOR, SOFR-based floating rate plus a spread. Historically, it's been LIBOR plus 450 to 500. When interest rates were zero, that translated into about 6 to 7% unlevered, 10% levered. Today, because interest rates are elevated, we're getting about 10 to 11% unlevered and 14% levered for our funds. So in the 25 years I've been in this business, today is the single best time for the market. The vintages of private credit, 2023, 2024, are the best vintages, highest price, lowest leverage, and best documentation.
I like that, vintages of private credit. So when we talk about returns, the natural next question will be risk, especially now we're in a very interesting environment, obviously a lot of risk in the public debt market. Yeah. Ron, what would you say in terms of the risk that you're seeing and default rates and...
At the end of the day, we're in the business of understanding risk. We're not in the business of pricing loans, right? The pricing of the loan is always a byproduct of understanding what risk you're facing. And I think what's unique about our segment is that as a segment, it's better than other segments in the space with understanding different risk levels, different assets, and how risks change over time. And I think now that more and more real-time technologies get into this space, you can become more and more creative on the pricing, and the pricing become much more agile and on the go with the product than it used to be before. So it doesn't matter where you target, if you have enough visibility into what risk you're facing and how it's going to evolve over time, because risk in a specific moment of time is just a specific moment of time. It's always an evolution over time of a risk. You see a company, you want to see the evolution of the risk of the capital you provided. And according to that, you can escalate with different type of financing, mezz, junior, senior, all these type of hybrid structures.
Okay.
Yeah.
And what would you say to the point of risk, Volkan?
I mean, public credit or private credit, at the end of the day, this is credit risk. So if the borrowers, the companies you are lending money to do not perform, there's a good chance you might lose money. So that's what credit risk is. It doesn't matter if you call it private credit or special or something else. That's just a name. It's credit risk. So we have to ask ourselves how the companies will perform in this global market environment. That risk has risen in terms of underperforming, potential defaults. This risk is rising. We got to be honest about it. We cannot turn a blind eye. We have to be diligent about it. However, I do think institutions like my friends here, they spend a lot of time underwriting these credits, especially in the case of non-sponsored credits. I will think, ceteris paribus, if everything is the same, a traditional public credit recovery might be lower versus a private credit where there's much better documentation, etc. So I will bet that private credit recoveries especially might be higher than public. Another risk in private credit specifically is these loans are pretty much hold to maturity. Public loans you can trade. You can just put it out there, somebody else wants to buy it, maybe you can exit at 95 cents. In a private credit situation, that's not the case. You will have to hold it, ride it through, and see if you can get your money back and more. So we will see that these risks will develop, but I do remain positive. Risk versus return-wise, private credit market to grow more. Hopefully it will evolve into the right direction.
Yeah, it definitely gets... Yeah.
I could give you some perspective. So for 50 years, credit, 2% default rate. Very long time. During the financial crisis, 6% default rate. So went up 300%. However, senior secured private credit recovers 75% during the financial crisis. Second lien or mezzanine debt recovered 35%. So when you look at a 2% default rate and a 75% recovery rate, you've got maybe 40 basis points, 35 basis points of loss. That's why the asset class has been so exciting over the last 10 years.
Mm-hmm. What are you... Oh, sorry, Ron.
I have to relate to what you said. I think slowly but surely the market is going from recovery to prevention. I think today we have enough machine power, sorry to get back to that, to generate on-the-fly prediction that you actually prevent the default event when you integrate prediction methodologies together with legal methodologies to how to act when you predict a default around the horizon. So what we're going to see, in my opinion, is the trend that move from how can I secure the recovery to how can I generate a prevention of the default, then I'm less supported, dependent on securities, etc.
The best risk management in credit is done before you lend the money, right? I mean, you do the right work on predicting the future of the company. That's the best way to avoid losses. But as also Ted mentioned, where you attach in the capital structure is the biggest determinant of your recovery.
What about, what does Michelle think about, risk?
I think risk, it's all about margin of safety in our business. It's about understanding the various risks, understanding what you do when things go wrong, and if everything goes wrong for you, and the company doesn't do well, if the promoter is trying to walk away from you, What can I do? And in that scenario, do I get my money back? If the answer is yes, then you can lend. If not, it doesn't work. And it's all about building that margins of safety, because sometimes something will go wrong. And you need to be equipped to get your money back when it does.
Yeah, that's an important point. Most people don't understand. Private credit is an actively managed asset class. Liquid credit is passive. You can push a button on a Bloomberg terminal and sell liquid credit. Private credit, there's no market for. So you have to be a manager that has the resources, the infrastructure to enforce and collect your loans if they go bad. It's a very important point that he made that most people don't understand about private credit.
You put it very well. Private credit is active public credit very well.
All right. Well, I think, unfortunately, that's all we have time for. But thank you so much to our panelists. I think we had a very interesting discussion, varied views. So please give a round of applause for our wonderful panel.